His benefit was $26.10 a month.
I've only gotten $10.40?
5 forms. Not one of them has ever landed in your mailbox. Each one releases money that federal law already says belongs to you. The Social Security Administration has your work record. It has your spouse's record. It has your late spouse's record. And it will not call you. It will not write to you. And it will not flag your account when the check hitting your bank is smaller than the law allows. It processes what you file. Everything else just sits there. Here is what that costs a real household. One widow in Tennessee was collecting her own retirement benefit, a little over $1,000 a month, while her late husband's record sat untouched on the same system, worth more than twice that. The difference was $1,570 a month. She didn't lose it because she did anything wrong. She lost it because a separate form was never filed, and nobody at the agency is required to tell her it exists. $1,570 a month over a 20-year retirement is more than $370,000. One form, never mailed, never mentioned. And here is the part that should get your attention if you're anywhere near this. One of these 5 forms has a 6-month window. After that window closes, the money behind it is gone. Not delayed, not appealable, gone. And most people don't discover the form until they're 2 or 3 years past the point where they could have claimed all of it. So before you scroll on, sit with which of these 5 might have your name on it, because by the end of this, you'll know exactly which forms to ask for, exactly what to say when you call, and exactly how long you have to act. Before the first form, one warning. Because this money goes unclaimed for a single reason, everyone assumes it's meant for someone else. If you're widowed, one of these has your name on it. If you're married and both still here, you're wrong that this is a widow's issue. One form applies to you because you're married, and if you filed online, odds are it was never handled. If your home's paid off and money's comfortable, 2 of these have income limits higher than you'd guess. And if you live mostly on your Social Security check, the single biggest payment in this video is written for you. So drop a comment with your situation and your state. The limits shift by state, and I read them to shape what comes next. Quick note. I'm not a lawyer or a CPA, and this isn't personal advice. It's the briefing that lets you walk into that office already knowing the exact form to name. If that's useful, subscribe. These rules change every year, and this channel tracks what the agency never announces. The first form is called the SSA 10. Its full name is the Application for Widows or Widowers Insurance Benefits, and it is the single most expensive form most widows never file. Here's the mechanism, and it catches almost everyone. When your spouse dies, Social Security does not move you to the higher benefit. It doesn't calculate both amounts and ask which you'd prefer. It doesn't send a letter explaining you have a choice. It keeps paying you exactly what you were already getting, your own retirement benefit. And it holds everything else until you submit a separate written application. Reporting the death doesn't trigger it. A phone call doesn't trigger it. Only the SSA 10 triggers it. Let me show you what that costs when it isn't filed. I'll call her Patricia. She's 68, a retired school librarian, and she filed for her own Social Security years ago at 64. Her benefit came to about $1,040 a month. Her husband passed away, and at the time of his death, his own Social Security benefit was $2,610 a month. Under federal law, a surviving spouse is entitled to up to 100% of the deceased spouse's benefit, not half, not a reduced share, the full amount he was receiving. For Patricia, that's the difference between her $1,040 and his $2,610, $1,570 every single month that she was entitled to and was not receiving. When her husband died, Patricia did what almost everyone does. She called Social Security to report the death. The call took a few minutes. The representative confirmed it, stopped his payments, and arranged the one-time $255 death benefit. At no point in that call, or any call after, was she told she could file the SSA 10 and step up to his benefit instead of her own. So she kept collecting her $1,040 for 2.5 years. Now here's the rule that makes this permanent, and it's the 6-month window I mentioned at the start. When you finally do file, the survivor benefit can be paid retroactively, but only up to 6 months, and only cleanly if you're already past your full retirement age. Every month beyond that, 6 is simply gone. No senior official can override it. No appeal restores it. By the time a benefits counselor caught Patricia's gap, more than $47,000 had passed through the system under her late husband's number and disappeared. That 6-month cap isn't new, and it isn't a mistake. It was written into the program decades ago, back when a widow was expected to remarry within a few years, and the survivor benefit was treated as short-term bridging income. That assumption stopped being true generations ago. The average widow today has 20 years or more ahead of her. But the 6-month rule was never updated, and the agency has never been required to proactively tell widows the SSA 10 exists. The rule is old. The person paying for it is Patricia, right now. So here's exactly what to do. If you're widowed and collecting Social Security, open your account at SSA, Gov, or pull your benefit statement and look at your benefit category. If it says retirement insurance benefit and your late spouse had a higher Social Security amount than yours, you may be sitting in Patricia's exact position. Call Social Security at their main line and don't ask a vague question. Say, I'm widowed, and I want a written comparison of my current retirement benefit and the survivor benefit I'd qualify for under my late spouse's record, and I want to file Form SSA 10. Get the representative's name and the date. Remember that form number, SSA 10, because at the end, I'm going to line up all 5, and this is the one with the clock already running. The second form is the SSA 2, the application for spouse's insurance benefits, and this is the one that catches married couples who did everything right. Here's how it happens. When you go to SSA Gov and file for retirement, the system builds your application around your own earnings record. It asks for your information. It calculates your benefit. It processes what you submitted, and it stops there. It does not ask whether you're married. It does not calculate what half of your spouse's benefit would be. It does not surface the SSA 2. That's not a glitch. That's how the system is built. The agency actively encourages people to file online, and the online path returns a benefit based on your record alone. Under federal law, a spouse is entitled to up to 50% of the higher earner's benefit at full retirement age, completely independent of your own work history. Decades as a caregiver, years of part-time work, a lower wage career, none of it matters. The spousal benefit exists on your spouse's record, not yours. Take a real pattern. I'll call him Frank and her Susan. Susan spent 18 years as a home health aide, then 12 part-time keeping books. Her own benefit at full retirement age came to $890 a month. Frank spent 39 years as a civil engineer. His benefit is $3,200 a month. Half of Frank's is $1,600. Susan's spousal benefit should be $1,600 a month. She's been receiving $890. That's $710 a month she qualifies for and isn't getting, because she filed the retirement application the website walked her through, and the SSA 2 was never filed. No one mentioned it. The system processed exactly what she submitted. And there's a version of this most people don't know applies to them at all. If you were married for at least 10 years and you're now divorced, you're still entitled to a spousal benefit on your ex-spouse's record, as long as you're currently unmarried and your ex is at least 62. You do not need their cooperation. You do not need their permission. The agency will not notify them when you file. The income history is already in the system. The entitlement is already in the law. The form was just never mailed to you. So if you're married, or you were married 10 years or longer, call the main Social Security line and say this: I want you to calculate the spousal benefit I'd qualify for under my spouse's or my ex-spouse's record and compare it to my own. If you filed online and only ever got a benefit on your own record, there's a real chance the SSA 2 was never filed. Bring your spouse's Social Security number. If you're divorced, bring the date and place of the marriage. The comparison is free, and it takes about 15 minutes. If you filed online for your own benefit and never touched a second form, tell me that in the comments. I want to see how many of you this one hits. The third one isn't a Social Security form at all. Every month, Medicare takes $202.90 out of your Social Security check before it ever reaches your bank. The Part B premium. Most people treat it as fixed, the price of having Medicare. For a lot of seniors, it isn't fixed. Your state is legally required to pay it for you, not lower it. Pay it in full. The programs that do this are called Medicare Savings Programs, and they exist in every state. They run in 3 tiers, and the top tier does far more than cover the premium. It's called QMB, Qualified Medicare Beneficiary, and under it, Medicare providers are prohibited by federal law from billing you any cost sharing at all. No copays, no deductibles, no coinsurance, not reduced, prohibited. Walk the real value with me. Because the premium is the smallest part, the premium alone is $202.90 a month, about $2,435 a year. That's the number people focus on, but a typical Medicare beneficiary also pays somewhere between $800 and $1,500 a year in copays, deductibles, and coinsurance across doctor visits, labs, and specialists. And if you're hospitalized even once, the Part A deductible is $1,736 for that stay. QMB erases all of it. The real annual value of QMB for a senior with ordinary healthcare use runs $3,500 to $5,000 a year, not $2,400. The premium is the floor, not the ceiling. Here are the 2026 income lines, and watch how high they actually sit. For QMB, the top tier, monthly income up to $1,350 if you're single, or $1,824 if you're married. The middle tier, SLMB, goes up to $1,616 single, $2,184 married. The third tier, QI, reaches $1,816 single, $2,455 married, and that one pays your full Part B premium. The asset limit for all 3 is about $9,950 single, $14,910 married. And your home does not count, your car does not count, certain burial funds don't count. A Social Security check of $1,100 a month plus a small $400 pension is $1,500 total. That's inside SLMB. Your state can be paying that premium, and instead, you're paying it yourself every month. The reason no one tells you is structural. When you enrolled in Medicare, Social Security did not screen you for these programs. It wasn't required to. Medicare savings programs are run by your state Medicaid office, a separate agency, separate application, separate system. The federal enrollment and the state benefit don't connect in a way that serves you. You have to start both yourself, and there's one more piece of QMB almost no one knows, including some front desk staff in pharmacies. If you're enrolled in QMB and a provider bills you a copay, that bill isn't legal. If you've already paid copays, you're owed a refund. So if you're QMB and you're charged at an appointment, say this before you pay: I'm enrolled in the Qualified Medicare Beneficiary Program. Federal law prohibits cost-sharing charges for QMB enrollees. Please verify my status before billing me. To apply, call the Medicare line, ask to be connected to your state's Medicare Savings Program, and tell them you want to be screened for QMB, SLMB, and QI. It takes about 20 minutes, and tell me your state in the comments. The base limits are federal, but a handful of states run higher, and that changes who qualifies. The fourth form pays the most to the people who have the least, and it's the one where waiting costs you money you can never get back. It's supplemental security income, and the form is the SSA 8000. The thing almost no one realizes is that it's a completely separate program from Social Security retirement. Different application, different income rules, different asset limits, and you can collect both at the same time. A senior already drawing a Social Security retirement check can also receive SSI on top of it, a second monthly payment from a separate part of the system. In 2026, the maximum federal SSI payment is $994 a month for an individual, $1,491 for a couple. The asset limit is low, $2,000 for an individual, $3,000 for a couple. But your home doesn't count, and one vehicle doesn't count. If your Social Security retirement benefit is on the low side, under about $1,000 a month, and your savings are limited, SSI may be a payment you've been entitled to since the day you first enrolled in retirement benefits. And here's why it was never mentioned. When you file for Social Security retirement, the intake doesn't automatically screen you for SSI. The agent processes the retirement claim in front of them. SSI is a different program, and the question doesn't get raised unless you raise it. Now, the part that makes this urgent, and it's different from every other form in this video. Everyone so far had some retroactive reach. The survivor benefit goes back 6 months. Spousal can reach back. SSI has none. It pays from the month you apply. There is no back pay, ever. Which means the difference between filing this week and filing next month is $994 that simply never exists. Not delayed, never paid. So if this might be you, the move isn't to research it for a month. It's to call the main Social Security line and say, I'd like to know if I qualify for supplemental security income, and I want to file Form SSA 8000. If your benefit is low and your savings are thin, make that the call you make today, not the one you get to eventually. Every month you sit on it is a month gone for good. The last form only applies if you filed for Social Security within the last 12 months. If that's you, this may be the most time-sensitive thing in this video. Federal law gives you the right to withdraw your Social Security application and refile later, but only within 12 months of when your benefits started. After that window closes, the option is gone permanently. No exception, no extension. The form is the SSA 521, the request for withdrawal of application. Here's why anyone would want to. For every month past your full retirement age that you wait to claim, up to age 70, your benefit grows by about 8% a year. Someone who claimed at 62 locked in a permanent reduction of 25 to 30% for life. If you claimed early, then a few months later your situation changed. You went back to work, a spouse's income covered things. You simply realized you left money on the table. The SSA 521 is the one legal reset. You withdraw the application, you repay what you've received so far, and your benefit restarts later at the higher rate as if you never filed. 2 hard limits, though, and they matter. You can only do this once in your lifetime, and you must repay every dollar you and your family received on that application, including anything withheld for Medicare or taxes, before the withdrawal goes through. It's a reset, not a refund. Past the 12-month mark, the only remaining tool is suspending your benefit at full retirement age, which doesn't require repayment, but also can't undo an early claim the way withdrawal can. So if you filed in the last 12 months and you've had second thoughts about the timing, call the main Social Security line this week and ask exactly this. Is Form SSA 521 still available on my account, and what is my deadline? If the window's open, you'll know how many days you have. If it's closed, you'll know suspension is the fallback. Either way, you want that answer while the clock can still work in your favor. This is a one-time right, and once it's gone, it doesn't come back. There's a 6th mechanism I'm deliberately not walking through here, because it deserved its own video, and it already has one. If you or your spouse worked a government job that didn't pay into Social Security, a teacher, a firefighter, a police officer, a federal employee under the old civil service system. 2 rules called the windfall elimination provision and the government pension offset used to cut your Social Security and sometimes erased it. In 2025, they were repealed, retroactive to January 2024, and the agency has already sent out billions in back payments. But not everyone was caught, and some people who assumed the old rules made it pointless never filed at all. If that's you or someone in your family, the full breakdown, how to check whether your benefit was recalculated and what to say if it wasn't, is in a separate video linked in the description below. Watch that one next. So here are your 5 forms. The SSA 10, the survivor benefit with the 6-month clock already running. The SSA 2, the spousal benefit the online system never shows you. Your state's Medicare Savings Program application, where the premium is the floor and QMB is the ceiling. The SSA 8000 for supplemental security income, the one with no back pay, where every month you wait is gone. And the SSA 521, the 12-month do-over that closes for good once it passes. Add up what's actually at stake. For Patricia, the survivor form alone was $1,570 a month, more than $370,000 across a 20-year retirement. And the total cost of claiming all 5? Somewhere around 45 minutes of phone calls and account checks. That's the distance between what you're receiving and what federal law already says you're owed. None of these arrive in the mail. None of them are automatic. The system processes what you file and holds what you don't ask for, quietly, with no reminder and no exception. So the one thing I'll ask you to do is this. If you know one specific person this fits, one widow, one retired teacher, one friend whose name isn't on the higher Social Security record, send this to them directly, not a general share. One person, one conversation. That single conversation can change what they collect for the rest of their retirement. Tell me in the comments which of the 5 you're going to act on first. Subscribe if you want the changes the agency never announces, and I'll see you in the next one.